Well, welcome to another episode of Breakaway from the Rat Race. And today I have the pleasure of speaking with Bryan Underwood. Bryan is the founding principal of Responsible Residential and also Responsible Real Estate, both San Diego-based real estate investment company. Mr. Underwood started both of these companies after spending more than 10 years in the acquisition in his family business, A-1 Self-Storage in Castor Properties. I'm going to talk about that. And Responsible Residential is a San Diego-based residential development company focused on middle income housing. So this is a very exciting space. A lot of people investing in that, and we're looking forward to speaking with you, Bryan. Welcome to the show.
Thank you. I appreciate it. Thanks for having me. Thanks for taking the time.
My pleasure. A-1 Self-Storage, I think it's a very well-known organization, and it's very successful in the self-storage area. And so you were responsible for you were part of that family business. You're part of that family that owns and manages the self-storage, very successful. So let's talk about that. Let's talk about kind of like what your role was in that company, and then why the transition.
Yeah, good. So I spent, I got into the family business in 2007. It wasn't until I knew that I was so passionate about real estate and wanted to make a career out of it that I really knocked on the door in the family business and said, I love this stuff. About 2 years before that is when I sort of went down the rabbit hole in real estate and was just interested in how people value a building, how people value land. That was sort of the fundamental question that I was after. And so I thought, well, shoot, let's start by getting my salesperson license, right? Let me become a realtor and just see if that can help me and give me some tools. Long story short is I just read a bunch of books and I did a bunch of Google searches, and I had a mentor at the time that we found a piece of property in Santee, which is a submarket here in San Diego. It was owned by the YMCA. They wanted 250,000. We made an offer for 150,000, and they said, okay. So
Wow.
I went to a family member and I said, okay, I've been studying this stuff and I want to borrow $50,000. I want to go buy this land and I want to build an industrial spec building. And, I had an 8.5 by 11 sheet of paper. I just learned how to do a pro forma, back of the napkin, of course. And I said, here's how I'm going to pay you back. Well, in 2005 and 6, you kind of just had to have a pulse, unless you were just making some really poor decisions to make some money.
Yeah.
So long story short is we sold that property for $425,000, like 6 months after we bought it. Right. So I'm giving back the family member $50,000 interest. I think I walked away with like $70,000, put it in the bank, and I went, okay, how do I do that again?
Mhm.
Right. So that was 2007. I knocked on the family business door and I said, hey, I love this stuff. I want a job. I want a job in acquisitions. And there was a little hesitation at first, but my family is very large. And so they wanted to make sure that I was serious and I was passionate about what I was doing. And so I kind of fought my way into the acquisitions department. And, then we had a cliff, right? In sort of the 8, 9s, and 10s of the worlds. And so while I had a job and I was learning acquisitions from a guy named Tyler Exter, just super smart guy, I got to spend a lot of time sitting in his office asking very dumb questions. In fact, the first task he gave me was he had his like 12-page pro forma, and he said, go recreate this. Right. And I said, okay, never even been on Excel before. Right. Go recreate this. Yeah. I only knew, back of the napkin on my 8.5 by 11s. I wasn't on Excel yet. So this is 2007. And so anyway, through a lot of videos, it took me about 3.5 weeks. And I walked up to him. I said, I'm done. And he just kind of laughed at me like, okay, yeah, I'm not really sure if you're done. He said, here's a deal. Underwrite this deal. If you're within 15 basis points of where I'm at, then it's acceptable. And sure enough, it worked. Right. So anyway, I just started, in the business. Though I had a passion for real estate, I didn't know much about it. Right. I was learning, but I had the opportunity to learn from a great mentor, cut my teeth for 10 years. After about 1.5 years in the business, I went back to grad school and got a master's in real estate. Once I found out that a local program here and the University of San Diego offered that type of education, I
Yeah.
was like, how do I get in there? Right? How do
Mhm.
I get in there, and how do I further the theory of real estate while I'm also concurrently actively pursuing real estate in the family business?
Yeah, this is great. So let's talk about the family dynamics, because I think this is something that's very interesting, and not many people talk about that. Obviously, you're part of a very successful family and all of that, and even though you're part of that, and you would think, oh, you need like $50,000 to do this, people would think, people that don't know how, families that are working in business together, how that works, because you want $50,000 and you have money in the bank doesn't mean you're going to get $50,000. You
Correct.
actually had to prepare a business plan and say, okay, I'm going to do this. Well, tell us how you did this.
Sure. Not necessarily in the family business yet, right? This was a precursor.
Mhm.
Um, I had my comps. I went out and I said, here's what people are charging for industrial in a 7,500 square foot space. Here's the consultants that I've hired, architect, civil engineer. Here's the money that I'm going to spend. Here's what it's going to cost to build. I had sort of a friend contractor that gave me like a ROM pricing, and I sort of laid out, here's the process, here's the time, here's ultimately what the value is after we build it, and here's how I get you your money back, right? And
Yeah.
of course, I'm green, I don't really know what I'm doing, but I'm also working with a mentor of mine who was, I think, he's 25 years older than I am. So even then, he was still 25 years older than I am, right? And he
It
was,
works in
yeah,
funny ways.
yeah, right. Isn't that weird? So he wasn't necessarily like really skilled in real estate either, but he was a successful businessman
Yeah.
and had a lot of respect. And so the fact that I was working with someone who had this track record, and then it was a sound business plan, they put some chips on the table, and thank God it worked out.
Yeah.
Right. So yeah, you can't just say, give me some money, I've got an idea. Like that doesn't work
Exactly.
that way.
Exactly. So yeah, this is true for, if it's true for families, obviously it's true for everybody knows it's true for other investors, but yeah, they want to know what you're going to do with the money. They're going to know when they're going to get their money back, what kind of profit sharing they're going to have. And yeah, so this is fantastic. I think this is very good to kind of get an insight in a successful, family, and how they manage that, how they manage their family members, and they want to do something, and yeah, we can invest in you, but yeah, show me the money, show me how to
Show
show
it.
it.
Yeah. Show us what you're doing. Yeah. So this also give you a little color on the family business as well, is even though, in my mind, I'm thinking, why wouldn't I get a job? I just spent a couple years
Yeah.
sort of cutting my teeth, and I'm learning and I'm reading, and I mean, I'm just so passionate about this. And I was a little surprised when they were like, no,
Mm.
you're not a good fit here. And I'm like, well, hold on a sec. You guys are a real estate company, right? Like, yeah, this is what I want to do. And so when I was 12 years old, and all of my cousins, I have 40 cousins. Okay.
Wow.
And most of them are here in San Diego. So when I was 12 years old, I signed a family employment agreement, right? And it wasn't until 2007 that thing came back out. I had no idea, right? And they're like, "Well, let's review your family employment agreement and see if you check all the boxes," right? So it wasn't just because they're family. It was like, "Oh, come on in."
Yeah, yeah,
There's no nepotism whatsoever. It was,
yeah.
if you've got what it takes, we'll give you a shot because you're family. But I basically, what I did was work in like a 6-month trial period, because
Mhm.
I don't really take no for an answer if I really want to get something done. So I said, look, give me 6 months trial period. You go ask my boss, who's my mentor, Tyler Exter,
Yeah,
and if I'm wasting his time, I'll leave. I'm out,
yeah,
right? But 6 months later, I was there. In fact, I was there 10 years later, right? So
yeah, yeah,
it did
exactly.
work out. Yeah.
And Tyler, is he a family member as well, or is he external to the family?
He's external. So he was brought
Okay.
in actually 1992. So quick little history. In 82 is when the family built their first self-storage in Oceanside, California. And in 82, things weren't that great. So there was a little bit of horse trading going on with properties. And we
Yeah.
ended up with an industrial building off Oceanside Boulevard. And my uncle Brian, who actually still runs the company today, he said, hey, we should check out, at the time, mini storage. We should check out
Mhm.
this mini storage thing, right? But I mean, banks wouldn't touch it. They're like, what are you talking about? What do I lend on?
Yeah,
I
exactly.
lend on, I lend on
A
30-day
shed.
leases, right? What is this thing? So anyway, from 82 to
Yeah.
92, the family built 6 self-storages, but
Wow.
they were also building a lot of other things. My
Mhm.
grandfather was kind of a merchant builder. He would hang on to whatever he could. But in 92, they had some shopping centers, apartments, they had self-storage, kind of a little
Yeah.
bit of all the main food groups. And
Yeah.
Tyler was brought in 92. He was the president of 3 banks. That was kind of his career, but in the real estate department. So he like knew how to underwrite real estate. He knew the
Mhm.
relationships that were important in the banking industries. He knew how to present it to banks, right?
Yeah.
So in 92, there was this repositioning, so to speak, of the portfolio, and
Yeah.
let's go 100% self-storage. And
Mhm.
so
Yeah.
from 92 to 2000, when I got in there 7, we went from 6 to 40. And then my 10-year stint, we went from 40 to call it 58.
Mhm. Wow. Right. Excellent. Yeah. So I was just, it's kind of interesting that even though your family members say, okay, well, you're going to report to this guy, uh,
Mhm.
and you're going to show if it works out, if you can show him that you're fit for this thing, then okay, you're in. But you have to pass through the muster here, and then
Absolutely.
go to this guy. So that's very interesting. Yeah, because you're part of this. The family doesn't mean you're going to be part of the business, which is
Correct.
kind of
And I
interesting.
was interested in a lot of different facets of the business, because one
Yeah.
thing that the Castor family does very well is they really have the soup to nuts. So it started, I worked in acquisitions, and that's what
Mhm.
I did for 10 years. And so
Mhm.
it was about relationships, like a lot of business is.
Yeah.
And
Yeah.
it was, where does it make sense to buy a piece of land? I had to understand general plans and zoning and all, overlays, and really hone in on what is really a developable piece of property for our product.
Mhm.
And so that's really what, you go down that path, and you get really good at identifying land. You get really good at identifying owners and how to contact them, how to create relationships.
Yeah.
Ultimately, it could be in 2 days, or it could be in 6 years.
Yeah.
Uh, you sit down at a table, and you actually figure out how to make this deal work.
Mm.
And I'll tell you what, that's tons of fun.
Yeah.
And so we take it from there, go through all the entitlement process. I'd work hand in hand with our construction department, Tom Kearney, going through that process. And then as soon as we got building permit, it was passed on to construction. I wasn't really involved at that point. And then ultimately to the management team. So I was kind of like right up front, sourcing deals all the way through the deals entitled.
Yeah. Oh, excellent. So let's talk about the transition then, because then, I mean, you're comfortable, you're in, like most people would stay there. They say, well, I've made it. I don't have to worry about anything.
Yeah.
And but no, that for you, that's not enough. You decide to start responsible residential and responsible real estate. So tell us about kind of like why you decide to do this and what these companies do.
Sure, sure. I think so. You actually used a perfect word, and it was comfortable. And that's exactly what I was. And that's just not the way that my brain and my drive ticks, right? So I would say that 99% of the folks out there are striving to get what I had, which was like ultimate
Yeah.
security, and literally keep your head down, you'll be fine in 20 years type of mentality. But that's not what drives me. I have to be learning and growing, not just professionally, but spiritually and with my wife personally. And if I'm not growing in those areas, then I just feel like I'm losing out on life. And so while I do think companies can do this, but it essentially, from the top down, you have to create within an organization how people continue to grow themselves personally and professionally in that business. And this isn't a knock on the family. They do something very, very well. But there was not really any place for Bryan Underwood to grow more in that company. My next step would have been running the $1 billion business. And in fact, I had to internally say, when they ask you to run the $1 billion business, are you prepared to say no? And I got to a point in about 2015 that I said, yeah, because I'd rather rotate out of this, call it ultimate security with no potential, to, you know, a bunch of risk, but unlimited potential. And that was just, that was where my heart was. And those are the things that were on my mind. And of course I have a family and I owned a house. And so there were things that I had to do to plan for that. But ultimately it was, ultimately we had a business advisor that sat me down, and this was literally 2 weeks before I'm about to give my notice. And she sat me down, she said, okay, we're ready. You know, Bryan wants to know if this is your path to the next step. He wants to know if you're ready to be groomed into running the business. And I looked at her and I said, no, I'm leaving. And her jaw just dropped, you know, like, what do you mean? Where are you going? What are you doing? And, you know, it's been a wild ride. So, and I wouldn't change it for the world, because my growth from 2017 to now is probably 100x. And I mean that as like no joke, like 100x. There's no way I would learn, be able to make decisions and do what I've done in the last 5 years had I stayed in that role where, again, bless his heart, it was just, hey, just keep your head down, you'll be fine in 20 years. And that just doesn't fit my personality.
Yeah, I think there's something to be said about kind of like the challenges. There's definitely challenges when, you know, you don't have money and stuff like that, and you have to get everything started, and it's a challenge, definitely. But there's also other challenges, even if you are in a successful family, and then to kind of like just follow the path that's laid out in front of you. Well, there's another challenge there, because you could end up in kind of like an identity crisis where, you know, who's Bryan, you know, and what do I want to be when, you know, when I passed on to my children. I want to say, well, you know, it was what did I do? Well, I just followed what other has started from me. So you kind of have this identity crisis as well that you have to deal with, and you know, enhance kind of putting your mark on these two companies that you started, I guess.
Yeah. So, you know, going through that transition, of course, you know, about a year and a half earlier is when you start to plan for it. Right. And there's a lot of fun in vision and planning, and what do I want it to look and feel and smell like, you know, all of that. Right. And it goes back to, well, why are you leaving in the first place? Right. Well, I'm leaving for growth, period. I'm leaving for growth. You know, money is fantastic and we need it to live and we need it to survive, but it's a tool for us to be in business and grow together. Right. So I thought to myself, well, I like this term responsible real estate. And it sort of had this like doing what's right, you know, doing what's expected of you. But if you sort of break down, it's like your ability to respond. And I was like, oh, I kind of like that ability to respond. You know, I just spent, at that time, it was, I guess, 12 years or so, you know, in the family business. And I kind of, even though I was in acquisitions, I had wore all these hats. And I thought, you know what? It's about two people getting together, being in business. And when you sort of react to each other is when growth happens. So I kind of like that term, responsible real estate, responsible residential, has a few meanings. To me, it's growth centric. That's why we named it that way. And going out of the family business, I don't want to compete head on head in storage. I very well could have, you know, I mean, that was I knew everything about it. I had all the relationships, but I thought, you know what? There's more to life than just making money in storage and competing with my family. I sort of went out and I put my broker hat on for the first time, and I got some land deals. And I was like, well, I'm certainly qualified to broker a land deal, but I know nothing about residential. And they were residential properties. And that's when I started doing my research on the residential market, you know, obviously specifically in San Diego, and the lack of supply and the process. I'm like, gosh, it's the same process that you go through to build anything. You just have to really understand the product that you're building and the delivery to the market. And I thought to myself, shoot, I could do this. And that's where really then the passion of, wow, I'm actually like, I'm building a home for a family to live in. You know, you picture the husband and wife sitting at the kitchen table, like, you know, teaching their kids about life. Like, you're creating this space for them. And I just fell in love, pure and simple. I just fell in love.
Yeah. So tell me about the kind of like the strategy for each of these companies. You know, kind of what is, Yeah, what's the goal? What's the business model for these companies?
So we're focused mainly on build-to-rent product. So we actually have two build-to-rent product brands. One of them is Responsible Residential, and that is building build-to-rent townhomes and single-family home communities. That brand right there, we're actually just finishing up our first project in Santee, California, the same area that I bought that industrial land.
Wow.
10 townhomes, 3-bed, 3.5 bath. Awesome project. I have learned an absolute ton on this project. And we got certificate of occupancy on around July 1st. So we're getting ready to do the whole tenant and lease up. And we're actually going to be leasing that up and selling that at the same time to the marketplace. So I've got my offering memorandums already geared up. So we're sort of geared up to go to market with that project. And that, in short, about a 2.5-year project. We raised $1.5 million and got a $4 million construction loan. And we're going to be returning over 2x to our investors on that deal in about 2.5 years.
Wow,
Just a
excellent.
fantastic project.
Mhm.
We've
Yeah.
got a couple more in the pipeline, very similar to that, in and around the same submarket. And then the second one is a company called Responsible Urban. And it's kind of the way that it sounds. It's focused on much larger infill projects, mainly apartments. Okay, so it's focused on apartments, infill. That company I own with 4 other people, and you can find us at investwithbryan.com. That's Bryan with a Y. You can learn about me, learn about our team. Our team has over 100 years collective experience developing this type of product in San Diego. We've got the best architect and design team on this project. Our first one out of the ground as a team together is an 89 unit market rate apartment project in North Park. Yeah, it's a fantastic
That's a big
project.
infill.
It is. It is. Yeah. Well, you look like you're in a big city. I think you said you're in Los Angeles, right?
Yeah,
So, when you start talking about how much land costs, right? It's all a function of what can you put on it, right? So, while I might have paid $20 a square foot for my Santee land, you're paying $300, $400, $500 a foot for half the size of the lot, but because you're building a podium project. So that's 5 stories of wood frame over 2 of concrete. So it's considered a podium project.
Yeah. Okay.
Yeah.
Wow. So let's talk about some of the metrics for the build to rent, because I think this is kind of a new, these 2 things actually are kind of like a new trend, not really new, but I think they're kind of more like a thing going on about them. Like the build to rent is something that I think the numbers, I mean, when we looked at some of the cities, for us, it didn't make sense. Like we're looking in Memphis, Cleveland, St. Louis, the cost to build a house is a lot more expensive than for us to buy a distressed property, renovate it, and rent it out. So that's why these infill or these build to rent don't work. But obviously in a market like San Diego, where you can rent at a higher rent. And then, so tell us a little bit about kind of the metrics associated with the build to rent.
Sure.
And
so what we're trying to do on the build to rent communities is we're actually going through, and so like the townhome as an example, and the 2 more that we've got in the pipeline, these are what's called common interest developments, right? So a common interest development is not, it's like, it's not as fancy or as sexy as like a traditional subdivision where you've got roads and streets going through a project that's owned by the city, right? So a common interest development has like a condo map over it. So a lot of townhomes, a lot of attached homes have this.
Yeah.
You can do it detached this way.
It's kind of like an HOA, right?
So essentially you have to have CC&Rs, you have to have HOIs, and we go through that whole process.
Okay.
Even though we're building it as a build to rent community, to me, you're talking about a few extra bucks, few extra times. And if you know how to do it, you do it, because that's a contingency plan. I'm big on contingency planning, because Lord only knows what, you got your crystal ball. Sometimes you're right and sometimes you're wrong, right?
Yeah.
So, in the event, you've got to pull that off the shelf and you need to liquidate 4, 5, or 6 of these for whatever reason, you can do that, right?
Exactly.
But I start every project by running a build to rent model. Okay. So I'm looking at Obviously, my land acquisitions, I'm looking at my soft costs, I'm looking at my hard costs. And for me, in the San Diego market, on those build to rent communities, I'm trying to hit a minimum of a 6% return on cost.
Okay. Return on cost. Okay. Wow.
And,
Okay.
and so just as an, so, you know, as an example, like I think that's great right out of the chute. You know, rent is extremely strong. Build a rent, rental communities are extremely strong in San Diego. But in the event you say, gosh, prices are still really high, like we are in our Santee project.
Yeah.
If someone's going to pay me a 4 or 4/4 cap on that thing, and I'm building it for over a 6, well, I'm going to take that cash, give it back to our investors, and then we're going to go do another deal.
Yeah. 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 So that means, so let's talk about one particular house that how much would it cost to build that one single house, and how much
Yeah.
would you rent it for example?
Yeah, correct. So the one house, let's call it 5,250,000. You're now I got to take out my HP 12C here. I think I shut off my phone. Anyway, 525,000. We're renting each. Well, so we're starting rent is $3,750 a month.
Okay. Okay. Wow. Okay.
My 12C is over here, so I can't grab it for you. But
all right. No. So
but,
yeah. So no, let's just give an idea. I think you talked
yeah.
about so the 6%. So this is the return on the cost of building. So the cost of building is 525. I don't have my calculator either, so I just like, and I don't want to kind of start calculating here, but yeah, 3,750. And then is there any kind of like HOA costs or maintenance costs that comes on top of that?
So
for
the beauty about that is if we sell them in bulk, what we'll do, because in California we have a construction liability for 10 years, construction defect, and it's just inevitable.
Yeah.
Year 9, someone gets a hold of the HOA and says, hey, is anything wrong with your place? And then they come back and sue the developer. Yeah. So what we do is we restrict the sale for 10 years as condos, as individual units. And so someone is really, if we are selling that, someone is buying it. You got to think it's a 10-unit apartment project. They're just built as homes. They're 1,500 square feet, 3-bed, 3.5 bath, 2-car garage homes. Yeah. So you're just buying bulk homes, and we could sell those homes. So like the values are at a 4.3 cap rate at those 3,750. We're at like a $7.6 million value, but just down the street, those same townhomes are selling for about $800,000. Okay. So I'm taking a little bit less, right? A little bit less of a return, but I also get to sell it as an investment property to one buyer, as opposed to individual and taking on the construction liability risk. Does that make sense?
Yeah, it does. Yeah. Yeah, so that's interesting. So that means that at least you have multiple. It sounds like you have multiple exit strategies. So you can I can go and I can manage this, and this is my project, and I'm making some cash flow, 6% cash on my costs, and my investors are happy to get this cash flow. Another exit strategy is I can sell it as an investment property to someone else, and the tenant is in place, and it's a brand new building. And I'm not sure what their returns are going to be depending on how much they buy the property for. Sure. Or you can just kind of like sell each of these individual homes on the market and then sell them for what, $700,000 or $800,000 a piece, and Correct. Then do it that way. So I really like that. I really like the fact that you're really thinking about multiple exit strategies and be prepared for different markets, whatever could happen in the economy, right?
Right. So, I mean, one of the things that we chose to do as our companies, that this was new to me. I learned about real estate syndications in 2019, right? I've always done deals in the past where we're taking our own money and putting it into a deal. And I realized when you get out on your own, if you don't have that money sitting in your bank account, how do you do the deal? So, hence real estate syndication. And so this is the first time that this team collaboratively has ever offered our resources, our expertise, our projects to the public as investment opportunities. So now what we're doing, like we did with Santee and what we're doing with North Park and what I did with a Marina project, is we're actually putting together syndications, and we've got an investor portal. One thing that's different is my money's in with you. In fact, my
Mhm.
money's in there before any investor's money's in there. I
Yeah, yeah,
usually have, right, $200,000 that's not coming back to me, whether that deal gets funded or not.
yeah,
So,
yeah.
I mean, I'm at the most risk, and I'm happy to do that because I'm not going to present any investor any deal unless I'm willing to put my money up there and let it ride right along with you. Right. So, I mean,
Mhm.
I'm not just incentivized with our own cash. I'm incentivized with, a potential waterfall where if we hit a home run, I get incentivized even more.
Yeah, yeah. And you're saying so investors can go and find more information, obviously, on investwithbrian.com. And then
Correct.
they can find more information there. And then if they want to join the syndication for that community building or that real urban or real estate urban or
Yeah,
responsible
responsible
urban,
urban. All of our
responsible
deals will
urban.
go up there. So what we'll do
Yeah,
as a team, we'll put together, obviously we have all of our organizational documents done,
yeah,
your subscription, operating agreement, but we
yeah.
put together a nice, pretty deck that you can go through and review the deal. We
Mhm.
also put together and upload 20 to 30-minute webinars, and we
Okay.
walk through the project with you. So really, if you're in our investor portal, you're going to get exposed to all of our deals first.
Mhm.
You're going to get the first opportunity. I mean, we raised $5.5 million last year with deals, and on these particular deals, I only had a couple phone calls
Mhm.
because people learned about us.
Yeah,
They know us. They saw all the information, and they were like, "I'm in or out." It was nice, and I'm happy to get on the phone call and answer any questions. But
yeah.
you get on there and you learn about us. You see the projects that we're doing, and not all are going to fit you. But I love the opportunity to be able to present these investments to the public
Mhm.
and give them opportunity to build that wealth like I've never seen before. I mean,
Yeah.
when you pull all of the families out there that have just incredible wealth, what's behind it? It's
Mhm.
usually a lot of real estate. And so,
Oh, yeah.
man, let's focus on that. Let's use
Yeah,
our skill sets. Let's provide those opportunities. So,
yeah,
people retire after their day job, they're sitting back with this reoccurring passive income that I'm already enjoying at 40 years old.
yeah, yeah. What are the requirements for the investors out there? So it's do you have to be accredited investor? What's the minimum investment requirement?
Correct. We're $100,000 minimum investments, accredited investors. Um, Basically that's it. And we
Yeah.
could get, if you look that up, you'll see if you are. Even if you aren't, there's a way that I could find out if you are. So if you want to find us and still have that phone call, figure out if we're a good fit,
Yeah.
we can go down that path together.
Okay, that sounds good. And you were saying that for that community building, I think the equity multiplier was like 2 times. Is
Yeah, a
that
little
right?
bit more than two in 2.5 years. Yeah, that's
Yeah. And in
we
two and a
want to do a
half
lot
years,
more of
yeah.
those.
Yeah. So that's kind of interesting because a lot of the syndications out there, I mean, you get a two equity multiplier or 2.5, but it's over like 5 year period, and you're doing
Sure.
it in 2.5 in half the time. So
Yeah, well, again, that markets change all the time. We
yeah.
we typically run 5 to 7 year pro formas depending on the size of the project, and that's how we're
Mhm.
going to present it to you. But I'll tell you what, like I said, my money's right alongside you.
Yeah.
So
Yeah.
if there's an opportunity sooner than later for us to achieve these incredible returns, we'll do that, right?
Yeah.
I mean, we want to be able to either cash flow and hold on to these things for long term. But if someone's willing to pay more than
Yeah.
I'm willing to pay, it might be a good time to sell.
Yeah, we had a couple of apartment buildings like that in Memphis, and then we were planning to keep them long term with our investors. And then somebody came around and said, "Hey, we want to buy it for this much." And I said, "Oh, okay,
Okay.
okay,
That's so,
it's
yeah,
yours."
that's right. So it's, obviously, and we communicate every single month with our investors on every single deal. So they see right where we're at, they see what we're doing. We're always available to them. Again, incredible team. Go check us out, investwithbrian.com with a Y. On there, you'll be able to connect with me. You could see our team, and yeah, let's do some business together.
So where do you think the economy is heading in San Diego or in California in general in terms of rental space or real estate?
Yeah. So right now is a very interesting time. And one of the reasons why I like the development game is it keeps me focused on long-term goals, long-term objectives, right? Now, that doesn't mean I'm not in the weeds and I'm tracking fundamentals and what's happening, but I can't worry about what's happening next month if my project's not even going to be in lease up for 3 years. I care about what's happening next month because it's going to help me adjust my assumptions and do some risk adjusted analysis and figure out if our assumptions still make sense, right? The housing market is so strong. We could build 108,000 units tomorrow and we would just catch up with the demand that's out there. So we've got to build, actually, I thought it was 10,000. The newest report is 17,000 units per year just to keep up with natural demand.
Yeah.
And we haven't come
Yeah, we're
close
not
to
even.
10 in decades.
Yeah,
I mean,
that's right.
I think we're going to do maybe 6,000. We did 6,000 last year, maybe 7 this year. So, if you can put enough money in the deal, which I know that hurts our returns, but trust me, you want to put enough money in the deal because we're doing development. Let's get out there 3 years. Let's refinance. Let's enjoy that awesome cash flow. So I'm just about make sure we're putting up enough money in the deal up front. Okay, so minimum 35% equity in our deals. We want to work with the best lenders. And we are working with the best teams to execute. So it's going to minimize all the surprises. And if we get out there, I think our takeout loan, like again, we're doing adjusted risk adjusted analysis on that. But the takeout loan on these construction deals is our number one risk. And as long as I could go into that deal and feel extremely confident about where we are on that takeout loan, I'm pulling the trigger.
Yeah. So what in terms? So I like that. I mean, first of all, focus on long term. I think this is always a lot of people are saying, well, you shouldn't buy now. You shouldn't invest now. I'm going to wait for the big dip in the real estate market and stuff like that. And just like the stock market, I mean, don't try to time the market. You just like, if it's a good investment now, it's a good investment now. And if you look at 20 years down the road, it's going to be a good investment. It's going to be a better investment 20 years down the road.
You're right. I looked at so many of our deals when I was with the family business that we passed on. And I'm talking, the acquisition, the price that we were willing to pay was like the delta was like $200,000. Okay. $200,000 on at the time would be like a $10 million build.
Wow.
You can't touch building a self-storage for under 20 these days. I mean, it depends on the size but I mean, you just can't do it. So I'm like, so you're building the same project for half the cost. We passed on it for $200,000. And in 20 years from now, you're never pissed that you have that project.
Yeah.
So, you have to be able to raise the money. You have to be able to get the debt. You have to feel confident about the team and you have to feel confident about that takeout loan. And if you can line all those up, we're doing deals.
Yeah.
Not all deals are home runs, but they're there. Home runs are there too.
Yeah. Yeah. And I also like the fact that, about other people's money. I mean, this is always something that so many people are saying, oh, I don't have the money to do these, you're doing a $5 million deal and then you're putting like, a few $100,000 up front to get things going, get things started and organized. And then, getting other people's money to kind of invest in the rest and all of that. And I think this is something that's very important is to realize, and I always say, make sure you get to network with investors, get to invest with, because you're always short money. Like it doesn't matter how much money you have, you're always short a couple of millions. So it's always good to have some people that you can share your projects with and then say, hey, I have this thing that I'm doing and, $500,000 here, $1 million there. And then you can really grow your business and maximizes your return as well. So money is never really the big factor. If you have a good deal, if you have a good plan, just like the plan that you did when you even before you were in A-1 self-storage, you present that to your family and say, I have a plan. Can you want to send me the money? And that's right. So true. I mean, you can find the money if you can pitch the deal correctly to someone and you have a good network of people, you'll be able to find the money. Money is not the problem.
Yeah, no, it's a really good point you bring up, because if I present any of our deals, now I'm already out money. So I think it's a good deal, but if I think it's a good deal, I should be able to show other people that it's also a good deal. And if that money isn't coming in, if I don't have other people nodding their head along with me, I've got to sit back and say, what did I miss?
Mhm.
Right now, that hasn't happened yet. And I don't think that's going to happen because again, I've got so much money out up front.
Yeah.
I'm not putting my money out up front to do a deal.
Mhm.
I'm not just about doing a deal. I'm finding the best deals
Yeah.
in the marketplace.
Yeah. And the other thing too is that then, okay, well, I don't have the money, then I don't have the skills, then you build a team around you. And I think you're doing that. You were talking about your responsible urban, where you have a team of, with 4 partners, and then you have so much experience together, and that's your track record right there. And so, hey, I have a team behind me. Yeah, I don't know. I'm not an architect. I'm not a builder. I'm not this. I'm not that. But I can put a deal together and a team together to bring it to
Yeah.
success.
Yeah. Eric, you have to recognize that, as a developer, operator, syndicator, whatever you want to call it, you have to know a little about a lot of things to
Mhm.
be able to orchestrate it all. You eventually, I mean, you get better at some areas that you're focused on. And as an entrepreneur, you actually get good at a lot of different things because you're trying to scale a business and grow. But you have to recognize what you're missing and surround yourself with people that fill that skill set that you can learn from. One of the guys on our team is a guy named Michael Dunham, and he's been in the business for 40 plus years, and he's built tens of thousands of homes. And he is our development manager day to day, managing some of the best teams in San Diego to get these projects out of the ground. If I walked in day one and said, I'm going to build 89 units, that would have been very difficult for me to get that thing out of the ground. But
Mhm.
collaboratively with that team, people look at us and say, you're like the best undiscovered team I've seen in San Diego that we could actually place some money with.
Yeah, no, that's very good. So, Brian, if people want to, did we miss anything? Did you want to, anything else you
No,
want to
no,
mention that we missed? Okay.
good.
So if people want to reach out to you, obviously investwithbrian.com, Brian with a Y. And then in there, you're going to be able to find all his deals. You also mentioned that you had some webinars on your website, or it's coming up webinars or more information
Correct.
about all the things that you're doing. So I highly recommend that you go and visit his website and connect with him. As you can see, Brian is very friendly, and is going to share with you his experience and expertise, and as well as his investment. So Brian, thank you very much. It was a pleasure having you.
Thank you, Eric. Appreciate your time. I enjoyed it thoroughly.
Thank you for listening to Break Away from the Rat Race with your host, Eric Martel. If you want to share your story and experience with our listeners, please message us on Facebook at Break Away from the Rat Race. Also, please subscribe to our YouTube channel and our podcast on iTunes.